and welcome to Take5, a new take on global current affairs, politics and money, and delivered in about 5 minutes per episode. We're recording on the afternoon of 13th of June. Keir Starmer is still the British Prime Minister, Donald Trump is still the US President, and the war on Iran has entered its 106th day. For this episode, we ask the question, what is going on in the oil market? As we write this, the Brent futures market seems to be responding to claims from the White House that a memorandum is imminent that will end hostilities between the United States and Iran. For the record, that is close to the 40th occasion when such a claim has been made. So, we are allowed some skepticism, although oil traders may prefer not to go too long. But before we get too euphoric, let's take a step back. The first point is that Brent crude is not the oil market. Why is this? That is because the often quoted Brent price does not represent the price of a physical barrel of oil. It is a futures contract, traded on exchanges around the globe, noted as a reference for other oil contracts. The second issue is that physical or spot oil prices and futures contracts are not the same. We saw at the start of the Iran war, as scarcity of oil became a global issue, with 20 million barrels per day of physical oil blocked in the Straits of Hormuz, that the spread between physical oil prices and futures prices spiked to $25 per barrel as supply of physical oil became tight. Since then, we have observed that not only has the spread fallen, but the price of physical oil has fallen. There are three possible explanations for the fall in the price of physical oil. The first is that measures have been put in place to release strategic oil reserves to ease the shortfall caused by the war. The second is that where there is capacity, there has been an increase in output. And the third is that demand for physical oil has fallen. Consider the release of strategic oil reserves. When we look at the US Strategic Petroleum Reserve, we see that it was already depleted and currently holds only around 349 million barrels out of 714 million barrels authorized capacity. According to Reuters, the US has also boosted its exports to 10.5 million barrels of crude and fuel per day in May, overtaking both Russia and Saudi Arabia. However, these increases cannot fully offset the fall in supply through the Straits of Hormuz. That leaves demand destruction, which has taken place in various countries. What has also come to light, however, is the sharp reduction in oil imports into China. Before hostilities, China was a major export market for Iranian crude. In May, Chinese imports by tanker fell to 6.6 million barrels per day, from 11 million barrels per day imported on average before the war. Iranian crude is still being exported to China, but just at lower volumes. What is not clear is how China has been able to achieve this remarkable change without any apparent impact on its economy. As for the impact of the war, the US CPI inflation was 4.2% in May, up from 3.8% in April. While Trump expects the new Federal Reserve Chairman, Kevin Warsh, to take steps to lower interest rates, he may have to increase them, and quickly, which may lead to a political standoff. The world has lost an estimated 1 billion barrels of oil supply so far, and some analysts believe that this number will double by year end without resumption of supply. Hostilities may continue. Stocks are dwindling. The current calm cannot prevail indefinitely. Thanks for listening. See you next time. And please remember to subscribe for further episodes.